Income Tax Act, House Property Act, Charging Section 22. As per Section 22, the annual value of such house property along with land appurtenant thereto is calculated, which is used in earning rental income. The income earned from house property which is used for business or profession or for any other income source shall not be included in income from house property. Section 22 is completed. Now we have to compute income from house property. For calculating income from house property, the first step would be calculating gross annual value of house property. The manner of calculating gross annual value of house property is provided under section number 23 of House Property Head. Before computing gross annual value of the house property, we have to understand four types of house properties, which are: first is LOP property. The full form is let out property, which means that property which is provided on rent by the SSC for earning rental income. Second is SOP property, which is self-occupied property which is used by the SSC for its own residential purposes. Third is NOP property, which is not occupied property, which is neither used for residential purposes nor for rental purposes by the SSC. Fourth is DLOP property, which is deemed to be let out properties over and above a limit of SOP and NOP properties. The extra properties would be deemed to be let out properties and would be taxable for the purposes of income of House Property Head. Now coming to section number 23 for calculation of gross annual value of house property. In section number 23 subsection 1, gross annual value of LOP property is discussed. Before learning how to calculate gross annual value of LOP property, four terms are required to be learned. First is fair rent, second is municipal value, third is standard rent, and fourth is expected rent, fifth is actual rent. Fair rent is the rent which can be earned from any similar house property in the same locality. Municipal value is the value at which municipal tax is levied by the local municipality. Standard rent is the rent limit applied by Rent Control Act. Rent higher than this standardized rent cannot be charged by the owner of the house property. First, we would compare fair rent and municipal value and arrive at the higher value, which is also called Z value. Then we would compare Z value and standard rent and arrive at the lower value. This resultant lower value is equal to the expected rent. Then we would compare the values of expected rent and actual rent to arrive at gross annual value. If expected rent is more than actual rent and no other information is given, then expected rent is the gross annual value. If actual rent is more than expected rent and no other information is given, then actual rent is the gross annual value. If expected rent is more than actual rent because of tenant vacating the property mid-year, then actual rent will be the gross annual value even if actual rent is lesser than the expected rent. If expected rent is more than actual rent because of SSC occupying the house property for self-residence mid-year, then expected rent will be taken as gross annual value. Here, section 23 subsection 1 is complete calculation of gross annual value in case of LOP property. Now, section 23 subsection 2 is about calculation of gross annual value for SOP or NOP property, means self-occupied or non-occupied properties. The gross annual value of SOP and NOP properties is taken as 0, that is nil, because no rent is levied on such properties. In section 23 subsection 3, limit of SOP and NOP properties for an SSC is provided. As per section 23 subsection 3, SOP or NOP properties can be highest of 2 properties for any SSC. As per section 23 subsection 4, in case of more than 2 SOP or NOP properties, the extra properties would be deemed to be let out properties. As per section 23 subsection 5, stock in trade house property shall not be taxable under house property head for 2 years from the year end in which construction completion certificate is received. Now section number 23 is complete. We would arrive on section number 24. Section 24 is the section of deductions available under house property head. There are two subsections in section number 24. 24 subsection A, 24 subsection B. Before deducing the deductions available in section number 24 from gross annual value of the house property, we have to first deduct the municipal taxes paid by the assessee from the gross annual value of the house property to arrive at net annual value of the house property. For deducting municipal taxes from the gross annual value of the house property, two conditions are to be fulfilled. Firstly, the municipal tax is required to be actually paid, and secondly, it shall be paid by the assessee and not the tenant. After arriving at net annual value by deducting municipal tax from the gross annual value, the deductions under section number 24 shall be allowed. As per section 24 subsection A, standard deduction shall be allowed from net annual value of the house property, which is 30% of the net annual value of the house property. This deduction is fixed 30% of net annual value of the house property. No other deduction shall be allowed other than municipal taxes, standard deduction, and deduction for interest on loan for house property. In place of all other expenses on house property, only this standard deduction will be allowed. Now section number 24A, standard deduction on the net annual value of the house property, is complete. Now we would arrive on section number 24B, interest on loan deduction. Before calculating interest expense for deduction, we would learn how much deduction will be allowed in case of different kinds of properties. For example, LOP, SOP and NOP property. For let out property, whole amount of interest expense calculated will be allowed for deduction. But for self-occupied property or for not occupied property, the interest expense calculated will only be allowed for deduction till a particular limit. Such normal limit would be till 30,000 rupees and extended limit shall be 2 lakh rupees. The extended limit for deduction of interest on loan expense for SOP properties or NOP properties shall be allowed in the following conditions. First condition is the loan shall be taken for only construction or purchase of the house property. Second condition is such construction or purchase must be completed within 5 years from taking loan. Third condition is loan must be taken on or after 1st 4 1999. And fourth is proper certificate must be obtained from the loan provider for the sanction of loan. After learning how much deduction shall be allowed in respect of interest for different kinds of properties, we would arrive on calculating the interest amount. The interest amount shall be calculated in two parts. First part is pre-construction period interest, which is also known as PCPI, and second is current year interest. For calculating PCPI interest, we have to multiply the interest applied on loan amount to a particular period. This period will start on the date on which loan is taken and end on one of the following periods, whichever is earlier, either on the date at which the loan is paid or the 31st March immediately preceding the construction completion date. The total interest amount resultantly obtained from such calculation will be divided into 5 installments. So the deduction of PCPI interest shall be allowed in equal installments divided over 5 financial years starting from the year in which construction is completed. So for the construction completion year, only 1/5 of the PCPI interest calculated amount shall be allowed, and also for the next coming 4 years. After calculating first part of interest, that is PCPI interest, now we would come on calculating current year interest. Current year interest is only calculated when the loan is still not repaid in the current year. Current year interest is simply calculated by multiplying the interest percent to the loan amount for the whole year or for the time period in such year for which the loan is still unpaid. Now the total interest allowed shall be arrived at by adding first and second part of the interest, that is PCPI interest plus current year interest is equals to the total amount of interest allowed for deduction.